Good morning and welcome to the Central Bank of the Bahamas' industry briefing on the package of proposed legislative reform. I'm John Roll, Governor of the Central Bank. I'm only providing introductory welcome remarks, and those will be followed by as well brief introduction from our Deputy Inspector of Banks and Trust Companies, and then we will move into the presentations followed by the discussion. And we encourage those of you, particularly if you're joining virtually, to just type in your questions, if you have any, in the chat, and we will collate them, and at the end of the session, answer as many of them as we can. But certainly be reminded that there is also a period up until October 31st for us to receive written public comments on the submissions. And as is practice, when the central bank responds to the feedback from public consultation, we publish all of the submissions and comments along with the central bank response so that there is transparency. But your feedback is very, very important. Over the recent years, the central bank has been working to really amalgamate and pull together a series of reforms to the regulatory landscape for our supervised domestic and international financial institutions. And today we are pleased to present the highlight of these over the course of this morning and later this afternoon. This afternoon, for those who are interested in joining in again, there's a more concentrated focus on the credit union sector. But there are some common themes in the package of legislation and proposed reforms. I'll just touch on selectively on some of them. One of them is a focus on strengthening our domestic financial stability framework, particularly insofar as we talk about the safety net for depositors. When we think as well about how we structure the funding, backstop, and assurances for deposit insurance, that's also a focus, as well as an emphasis on preemptive planning as regards the resolution framework for banks and credit unions particularly. Another theme is consolidating and strengthening the oversight space for payments and money services in general. And this also will provide an enhanced framework for to push on financial inclusion ideals, as well as to give the central bank the inroads to address, consumer financial protection ideals. We're also focused on, as a highlight, on consolidating and strengthening the enforcement regimes holistically for all of the central bank supervised financial institutions. And I think you will hear a bit about that in terms of how the administrative penalties regime is better situated in the legislative framework. But just to say, as regards credit unions, which are all members of the deposit insurance systems, as well as members of the credit bureau, what the central bank is essentially proposing is reforms that would put more emphasis on strengthened governance mechanisms, placing increased emphasis on risk management framework within credit unions, and more oversight, particularly of the recruitment and appointment processes for persons who are at the helm of these institutions, either at the board level or senior management. And these sort of reforms are similar to the mechanisms which are already in place for banks. And so while these reforms are being put forward, it is still recognizing that there are some characteristics that are unique to these financial cooperatives that still have to be preserved, notwithstanding the enhancement of the prudential aspect of their operations. Now, in the money services space, there will no longer be a licensing distinction between payment services institutions, and that's the caption under which a lot of the new mobile wallet providers would have been licensed. And there won't be a distinction between how they are licensed and looked at relative to money transmission business services, which, and this is recognizing that there's essentially equivalency between the way these types of businesses operate and the range of prudential oversight that are already applied to them. And therefore, the distinction um, really is only historical in terms of how they were introduced to the system, and it's no longer sensible to keep them regulated under separate places in our existing framework. The reform to payments also address the clarity and mandate that the central bank would need to have in pursuing issues such as access and inclusion to financial products and services in the domestic banking and payment space, especially at the transactional level. These are expected to, once fully fleshed out, to empower the central bank to begin to address more holistically, for example, consumer protection matters as may relate further to fee setting and other practices relating to products and services that are used for payments. And the products and services that we're talking about would be like your savings, checking account, mobile wallet used for payments, as well as instruments such as credits and debit cards that are also used in payments. And so there's work that needs to happen in this space to address a lot of the access and consumer-related issues. Any work in this space, though, will continue to be based on public consultation and informed by international best practices and appropriately tailored to the circumstances that are important for the Bahamas. I should also point out that potential rules, guidance, and regulations to give full force to other aspects of the reforms that will be outlined today will also impact, legislation and outside of just the payment space. So just be mindful of that. But whatever is proposed or advanced beyond today still follows the principles of public consultation and the central bank taking account of public feedback before we advance to any adoption of proposals. There are other principles which also guide the legislative proposals that will be aired, and you will get to hear about them as the presentation proceeds. We are going to be, asking to receive feedback from industry as well as the public in general on these. Bear in mind that you have until the end of October to do so, and we welcome receiving feedback from all quarters. With that said, I want to thank you all for joining the session today, whether you're here in person or you're joining via the webinar link, and we look forward to your feedback and input. Having said that, I will now invite our Deputy Inspector of Banks and Trust Companies to give some introductory remarks as well, and then we will move into the meat of the sessions.
Thank you, Governor, and good morning. As Governor indicated, I am Cherise Saunders, the Deputy Inspector of Banks and Trust Companies in our Bank Supervision Department. And on behalf of our department, I'm pleased to welcome you to today's briefing as well on these proposed legislative reforms that were issued by the central bank in the form of 2 consultation papers at the beginning of the month. As our supervised financial institutions are aware, the central bank and the Bank Supervision Department in particular typically conducts an annual industry briefing during the first quarter of each year to share supervisory priorities, upcoming initiatives, as well as the central bank's policy work for the year. At that time, we also take that opportunity to discuss any relevant legislative updates. However, given the nature of the compendium of legislative reforms currently contemplated, we thought it important to hold this special session to highlight some of the substantive aspects of the reforms and hopefully stimulate constructive feedback during the consultative period, which ends on the 31st of October. As noted in the release of the papers and as Governor would have highlighted, the proposed legislative reforms are designed to enhance the financial regulatory framework, strengthen depositor protection, and improve overall the resilience of the financial system. These continue to be high priority objectives of the central bank. Per the agenda, you'll see that we have 2 sessions planned for today, and our legal team will walk you through the amendments being made to key legislation, in addition to sharing new regulatory frameworks being proposed. Firstly, in the morning session, the focus will be on the general reforms, payment instruments, and the resolution framework for systemically important financial institutions. The afternoon session will provide an update on key amendments to the legislation governing the credit sector, which seeks to enhance the supervisory and regulatory framework for this sector. We will do our best to answer any questions you have today, but we also look forward to your helpful feedback over the remaining consultation period. Again, I welcome you to the briefing and hope you find the sessions both informative and helpful in your understanding of the proposed reforms. With that said, I will now turn it over to my legal colleagues, led by Stacey Benjamin, our legal counsel, Vandira Carey, our deputy counsel, and Narissa Knowles, our assistant legal counsel. Thank you.
Okay, good morning, everyone. As was said, my name is Narissa Knowles. I am the assistant legal counsel here at the Central Bank. And first, I want to thank everyone for joining us today at this briefing on the Compendium of legislative reforms. And so I'm excited to walk you through some of the more and some of the few important proposed legislative amendments that impact the financial services sector. So I will be covering 3 key areas across 4 pieces of legislation. The first being the draft Central Bank of the Bahamas Amendment Bill 2025, the draft Banks and Trust Companies Regulation Amendment Bill 2025, the draft Protection of Depositors Administrative Monetary Penalties Regulations 2025, and the draft Central Bank of the Bahamas Administrative Monetary Penalties Regulations 2025. So my goal isn't to just read through the paper, because of course you can do that for yourself, but I do want to help you understand some of the changes that we will be proposing and explain to you why those matter. And of course, what we are proposing for these amendments and legislative changes are to, inter alia, strengthen the central bank's supervisory powers, broaden access to financial services, and revise the legislative framework for the enforcement of administrative monetary penalties. So I'll start with the draft Bank and Trust Companies Regulation Amendment Bill 2025, or the BTCR Amendment Bill for short. So the key objective here is to introduce and modernize agency banking, also allow for bank and trust companies to appoint agents to provide payment services, and this will ensure central bank oversight as well as accountability for financial institutions. So let me show you how we propose to accomplish these 3 things. So clause 6 of the draft bill deals with appointment of agents. And what clause 6 does is it repeals and replaces section 11 of the Principal Act to allow for bank and trust companies to offer payment services via an agent. So if financial institutions wish to offer payment services via an agent, they can do so first with written approval by the central bank. That application itself must first include prescribed information and references. And of course, the central bank will assess that application against regulatory standards before approval is granted. Clause 6 deals with these three main points. I'll move on to Clause 7, which speaks to liability of banks and bank and trust companies. So what Clause 7 is doing in the bill is it's repealing and replacing Section 12 of the Principal Act to make it explicitly clear that bank and trust companies are to remain responsible for the acts and omissions of their agents. So as long as those acts and omissions of the agents deal with the business of the bank or the bank and trust company, even though you allow for payment services to be utilized through an agent, the bank or bank and trust company will remain liable and responsible for those agents. So what this does in practice, it reinforces that delegation doesn't reduce accountability. The accountability will remain with the bank and the bank and trust companies. And of course, as what we are attempting to do is to, as service in this space expands, again, the accountability and consumer protection still remains. So to sum it up, the BTCR amendment bill does two things, basically. It introduces the framework for agency banking. It expands financial inclusion through expanding customer access, and all of this will clearly keep liability with the bank and trust companies to protect consumers. I'll now move to the draft Central Bank of the Bahamas Amendment Bill 2025. So the Central Bank Amendment Bill, for short, does three main things. It first introduces a two-tier penalty system. It introduces a new category, namely small supervised financial institutions, and it also provides needed and necessary clarity on terminology, specifically for violations and enforcement. So I'll start off with the first two, that is the introduction of the two-tier penalty system and the new category, small supervised financial institutions. So this is dealt with in Clause 21 of the bill, and that deals with penalty tiers. So Clause 21 amends Section 47 of the Principal Act and introduces two tiers of maximum penalties for late filings. So the first tier being for the newly defined small supervised financial institutions who will have a maximum penalty of $1,000 for late filings. Of course, the bill also defines who are small supervised financial institutions, and they are namely trust companies authorized for limited services, such as those that conduct trust business with specified persons only, or for those who offer nominee services only. Secondly, registered representatives. Thirdly, cooperative credit unions. And lastly, licensed payment institutions. That's the first tier. Okay. The second tier would be all other supervised financial institutions outside of those four that I just named, and they will have a maximum penalty of $10,000. And finally, the $250 per diem penalty is retained, and that still applies. So it's a $250 per diem, $250 per diem penalty that will still remain. So what this tiered approach is doing is ensuring proportionality. So you have two categories, and the penalties for each category will be proportionate to their size. I will now go to Clause 22 and 23 that provided the clarity on certain terminology. So this clause makes consequential amendments to Sections 48 and 49 of the Principal Act to standardize terminology specifically replacing words like contravention with violation. And so why is this important? Why does this matter? It makes enforcement language consistent across the act, and it reduces confusion and helps the institutions to better understand compliance requirements. So in other words, nobody should be left guessing what the terms mean, what counts as a violation, and how it will be handled. So in summary, the Central Bank Amendment Act does two main things. It introduces proportional penalty tiers, and it clarifies enforcement language. So I'll now finally go to the administrative monetary penalties regulations, which have two AMP regulations now. So these include the Central Bank of the Bahamas Administrative Penalties Regulations and the Protection of Depositors Administrative Monetary Penalties Regulations 2025. So the goal of both of these is to expand and standardize the AMP framework across all supervised financial institutions. So let me start off with the Central Bank AMP regulations. So by way of background, just a very brief history lesson. The original AMP regime was established under the BTCRA 2000 Act, whereby the 2016 AMP regulations were introduced. So let's call those 2016 AMP regulations the old AMP regulations for clarity and ease. So under that old regime, the AMP framework only applied to financial institutions that were licensed and approved pursuant to the BTCRA. In 2020, the BTCRA 2000 was repealed, and the AMP framework was placed under the Central Bank of the Bahamas Act. Okay, so that 2016 framework was brought into the Central Bank of the Bahamas Act, and that allowed for the AMP framework to apply to all financial services institutions supervised by the bank. But we want to ensure that that is patently clear. And so what the central bank is intending to do is to revoke that old 2016 AMP regulations and introduce brand new Central Bank of the Bahamas AMP regulations that will make it clear that these apply not only to banks and trust companies, but also to cooperative credit unions and payment institutions. And you'll see that in the new regulation too. Now, it'll be clearly stated in the new regulation too that this applies to cooperative credit unions as well as payment institutions. Regulation 4 now classifies violations by severity. So there's minor, serious, and very serious. Penalties will be scaled to severity, and it will be clear that it will be based on, the violations will be based on who is committing them. So it will be, for example, individuals versus companies. So you will see that violations committed by individuals will be differentiated from violations committed by companies. And you'll see how the penalties are scaled to each class. Finally, Regulation 5 does a number of things. First of all, it distinguishes between late and erroneous filings. It proposes that erroneous filings would no longer attract a per diem penalty, but instead, penalties for erroneous filings would vary based on whether the error was discovered by the central bank or if it was discovered by the financial institution. So I want to make that clear. So if it's discovered by the central bank, the penalty is $1,000. And if it's discovered by the financial institution, the penalty is $500. And so this approach, and we believe that this approach will encourage institutions to self-identify their own errors, and it will foster a proactive compliance. So basically, it will save you money to, establish or report your own erroneous filings before the central bank discovers it in the long run. Finally, the central bank AMP regulations also define what large supervised financial institutions are. Those are banks or trust companies that conduct business with the general public. So we know who large supervised financial institutions are, and we also have an idea of who small supervised financial institutions are. And I will go to now the protection of depositors AMP regulations. So this specific AMP regulations, the PD AMP regulations for short, these fall under the Protection of Depositors Act and deal specifically with deposit insurance, okay? Of course, this ensures that Bahamian depositors are always protected. So what the PD AMP regulations are doing, or what we propose that they do, is one, bring the cooperative credit unions within the ambit of the broader protection framework, and they will be categorized as small member institutions. And you will see their categorization, the cooperative credit unions categorization in Regulation 5. But in Regulation 2, it brings the cooperative credit unions within the ambit of the broader protection, depositor protection framework. Regulation 4, similar to the Regulation 4 of the Central Bank AMP, classifies violations based on severity. And so you will see minor, serious, and very serious, quite similar to what we just discussed with the Central Bank AMP. Finally, Regulation 5, also similar to the Central Bank AMP, differentiates between late and erroneous filings. So I spoke about erroneous filings the last time. Let me tell you what's going on with the late filings under the PD AMP. With late filings, you may attract a penalty of $250 with a per diem of $250 for each additional day of the violation. Okay, so that's what distinguishes between the late filings. There's a $250 penalty and then $250 per day as the violation continues. And that's up to a maximum of $10,000 for large member institutions and $1,000 for small member institutions. And we know what large is and we know who the small are. So if you're a small member institution, that is cooperative credit unions, it's a maximum of $1,000. And also, as I have here, it will also be based on who discovered it. Okay, if the violation was discovered by the corporation, it will be less as opposed to, if the violation was discovered by the member institution, it will be less as opposed to if it was discovered by the corporation itself. So again, we believe that this encourages proactive compliance because it will save you to report your erroneous filings before the corporation discovers. So I'm to the end of my presentation, and so the key takeaways that we hope for SFIs to take away from these new proposed legislative reforms is greater access, same accountability, penalty reform for fairness and proportionality. I think that is very clear that the proportionality and the fairness of the penalties now correspond to the size of the institution. The AMP protection regime is expanded for stronger and more consistent coverage, and of course, it's going to encourage compliance among the SFIs, and also, as always, we want a strong undercurrent of consumer and customer protection. So, just in closing, I will just in a very quick synopsis capture the legislative reforms for these 4 pieces of legislation. Again, the BTCRA amendments introduces and modernizes agency banking while protecting consumers. The central bank amendments ensures proportional, clear enforcement, and the AMP regulations expand coverage and promotes proactive compliance. So we think these changes are crucial. And if you have any feedback, if you have any feedback, you can provide that feedback by the end of the month. And of course, to the policy unit at that email. And if you have any questions, you can use that contact. So thank you very much for your attention. And I'll turn it over to my colleague, Ms. Stacy Benjamin.
Good morning, everyone. And my name is Stacy Benjamin. I'm the legal counsel. And this morning I will be focusing on two key areas of reform discussed in the consultation paper. So let's get right into it. The first area concerns the legislative reforms that affect the payments institutions and money transmission businesses. And secondly, the reforms proposed in relation to the resolution framework. So turning first to the payments and money transmission framework. The bank proposes amendments to three pieces of legislation: the Banks and Trust Companies Regulation Act, and commonly referred to it as the BTCRA, the Payment Systems Act, and Payment Instrument Oversight Regulations. When enacted, one of the key outcomes of the proposed amendments is that money transmission service providers will now be governed under the broader payment institutions framework, aligning their regulation with international standards for payment services. Currently, the licensing and regulation of non-bank money transmission service providers are governed under the provisions of the BTCRA, which, as we know, is also the principal legislation for the supervision and licensing of banks and trust companies. Money transmission businesses, or MTBs, must also adhere to the provisions of the Banks and Trust Companies Money Transmission Business Regulations 2008, or the MTB regulations. However, as money transmission service providers essentially are offering the same services as other payment providers, the proposed amendments to the legislation will move money transmission businesses into the payments legislative framework of other non-bank payment providers. And this is aligned with global best practices and ensures that these institutions are properly regulated under a consistent framework. To this end, the amendments remove provisions relative to money transmission services from the BTCRA and place them under the Payment Systems Act and the Payment Instrument Oversight Regulations. So, for example, the amendments will remove the terms such as money transmission agent, money transmission business, and money transmission service provider from the BTCRA, while introducing new terms into the PSA, the Payment Systems Act, such as payment services. And that term will be defined in the Payment Services Act as services enabling deposits and withdrawals, as well as the provision of money transmission business. We also introduced the term payment institution, which will be defined as an entity that is licensed to provide payment services like money transmission businesses. Likewise, sections which address the licensing requirements will be amended to allow non-bank money transmission service providers to be licensed under the Payment Instrument Oversight Regulations as payment institutions and authorized to provide payment services. These amendments will also expand the bank's oversight powers to include the power to prescribe the standards for payment services and to be maintained by payment institutions, and also to make regulations prescribing the standards to be maintained by payment institutions. As a result of these changes, the MTB regulations that I mentioned earlier which are currently issued under the BTCRA, will be repealed. The transition of MTBs under the payments framework will encourage regulatory consistency, as well as strengthen the bank's oversight of payment instruments and providers to better protect consumers and enhance operational resilience. To achieve these objectives, the bank proposes several amendments to the legislation, which will, in essence, clarify that the central bank's oversight powers include the regulation of any services that enable deposits and withdrawals, as well as the licensing and regulation of electronic money issuers and payment institutions, under the guidance of the Principles for Financial Market Infrastructure issued by the Committee on Payments and Market Infrastructures. The amendments will also update and clarify that the licensing regime under the PSA and the payment instrument oversight regulations include e-money issuers and payment institutions, inclusive of non-bank and non-credit union money transmission service providers. They will also expand the basis on which the central bank may revoke a payment institution's license under the regulations, the PIOR, to include where a payment institution does not meet the conditions of its license or is in breach of any terms or conditions imposed or directions issued by the central bank. The amendments will also strengthen consumer protection measures, which will lead to increased public trust by users. So, for example, the amendments to the PSA introduce an explicit mandate for the central bank to have regard to the interests of consumers when exercising its powers. And lastly, the amendments will also expand the provisions in the PIOR, the Payment Instrument Oversight Regulations, which address the record-keeping obligations and public disclosure requirements for payment service providers, who will now be required to disclose external auditor appointments to the central bank and mandate that external auditors shall be chartered accountants or certified public accountants. So what are the key outcomes and implications for payment institutions? And I've listed 3 for your consideration here. Basically, the proposed changes will ensure consistent oversight and supervision by the central bank and align providers like MTBs with rules for payment instruments and electronic money and other non-bank and non-credit union payment providers, as well as promote safeguards for all consumers. So now I'd like to move into the key reforms that affect the resolution framework. And I've listed a number of reforms here. And basically what these reforms will do will enhance the framework that is already in place. So with the enactment of the Banks and Trust Companies Regulation Act in 2020, the central bank established a very strong legal framework for bank resolution. And that framework was modeled closely on international standards for effective resolution regimes for financial institutions. The deposit insurance legislation, which is the Protection of Depositors Act and the Protection of Depositors bylaws, were also amended in 2020 to further clarify the role of the Deposit Insurance Corporation and expand its coverage to include cooperative credit unions. These current reforms, are part of the central bank's ongoing efforts to continue to modernize the resolution framework, aligning with international standards and best practices. So what we intend to do and what we propose is to introduce further amendments to the principal pieces of legislation that were overhauled in 2020. So the first being the Banks and Trust Companies Regulation Act, the BTCRA, the Central Bank of the Bahamas Act, the Protection of Depositors Act, as well as the Protection of Depositors bylaws. And these legislative proposals are designed to assist the central bank in operationalizing the bank recovery, resolution, and the amended depositor protection regimes, as well as strengthen the resolution frameworks for banks and cooperative credit unions. Now turning to some of the key reforms. First, the expansion of the resolution regime to include cooperative credit unions. So the proposals will expand the resolution regime for banks, which is currently set out in the BTCRA, to cooperative credit unions, which are designated as systemically important institutions. The amendments extend the risk management and resolution tools beyond banks to also safeguard the credit union sector and empower the central bank to exercise resolution powers in respect of failing credit unions, but only those which are proportional to their size, nature, and feature. So, for example, one of the amending provisions addresses the appointments of statutory administrators of holding companies and affiliated operational entities, and also resolution tools such as establishing bridge institutions and asset management vehicles. But those provisions only apply to the banking sector, so they will not apply to the cooperative credit unions. However, both banks and cooperative credit unions, which are defined as pertinent financial institutions in the draft legislation, will have to prepare and submit to the central bank recovery plans to restore their operations to acceptable levels of financial and operational soundness, which are reviewed, and those plans are reviewed by the central bank annually. They're also independently reviewed and tested for effectiveness. There are also reforms which touch on the distinct roles for the supervisory and resolution authorities within the central bank. And what I mean by that is the bank itself has dual functions with respect to supervision of the sector and also acting as the resolution authority for institutions that are in trouble. And the reforms also empower central bank as resolution authority with broad powers to implement certain resolution strategies. And they also introduce a statutory administrator role for bank holding companies and affiliated operational entities. So just touching on those 3 points, I'll just summarize that the amendments that are proposed will further define, as I said, the central bank's role as the resolution authority, to include identification of the systemically important institutions, appropriate resolution strategy before appointing a statutory administrator. So currently under the BTCRA, the statutory administrator is required to prepare a report for the central bank on any bank which the central bank deems is in trouble, and to which the administrator has been appointed to determine appropriate remedial or resolution actions. In doing this, this may create delays in the resolution process, as the statutory administrator is unable to take immediate action to implement whichever strategy is eventually selected. So to address this, the proposed legislation will empower the central bank to assess the resolvability of systemically important institutions, to determine whether there are any impediments to their orderly resolution, develop and implement any resolution strategies or plans, or apply any resolution measures to troubled institutions which the central bank deems fit, including appointing a statutory administrator of a holding company of a bank, as I mentioned earlier. Also, to ensure continuity of critical financial services, one of the resolution measures that the central bank may also exercise is to appoint a statutory administrator to an affiliated operational entity that performs critical functions or services for the bank. The proposed amendments also seek to ensure that depositors receive preferential treatment and mechanisms to protect public funds during resolution. And this is with respect to the last bullet point here, strengthening safeguards, including depositor preference and flexibility in creditor treatment. So the BTCRA 2020 made provisions at that time for shareholder and creditor safeguards, and to afford stronger protections for creditors and allow greater flexibility in developing resolution options in line with international standards. These amendments will introduce provisions that will give the central bank the discretion to depart from pari passu treatment of similarly ranked creditors, either to prevent contagion in the financial system or to maximize the bank's value. The proposed amendments will also introduce depositor preference that places deposit liabilities in a more senior position than other a more senior position than other senior unsecured creditor claims, and also require an independent valuation of assets and liabilities to inform the central bank's resolution actions. We also have proposed amendments to the central bank's sanctioning powers to broaden those powers to include revocation of licenses for institutions under unresolved statutory administration, and the sanctioning powers of the bank under Section 29 of the current BTCRA will be expanded to include the power to revoke the license of any bank placed under statutory administration that cannot be rehabilitated or restructured. The amendments will also allow the central bank to appoint a statutory administrator to, as I mentioned earlier, not only a bank, but also the holding company of a bank that's under statutory administration, or any subsidiary of the holding company or bank that provides the services to the bank. And so, as I mentioned before, this is really to ensure that critical functions of the institution continue during a statutory administration. The proposed amendments are also intended to strengthen the framework and operational capacity of the DIC, that's the Deposit Insurance Corporation, by ensuring that Bahamian depositors are always protected, irrespective of the financial balance in the corporation's fund. This will facilitate confidence in financial institutions, the absence of which may lead to preemptive runs from weak but otherwise solvent institutions. To achieve this, the proposed amendments make provision for the DIC to have access to a dedicated, prearranged emergency credit line from the central bank that is sufficient to meet liquidity needs. These emergency funds would be supported by government guarantees and repaid to the central bank from asset recoveries or levies on member institutions of the deposit insurance scheme. The proposed reforms will also place appropriate safeguards on the use of public funding for bank resolutions. So the legislative proposals make provision for the central bank to make advances to the DIC only for the purpose of maintaining financial system stability and supporting a resolution measure undertaken for a member of the Deposit Insurance Fund. In doing so, the government must guarantee repayment in writing, and the central bank must be satisfied that such loans are necessary to prevent systemic risk posed by the failure of a member of the DIC. The proposals also introduce new provisions under the PDA, the Protection of Depositors Act, that will empower the DIC to provide funding to support resolution measures that are undertaken for member institutions as the central bank may determine, while limiting the use of the DIC's funds to an amount it would have paid to depositors in a liquidation and setting a maximum of the existing fund that could be used in resolution. So this is here with addressing the point of expanding the DIC's powers to support the resolution actions and also define permitted loans. The draft amendments to the PDA also make provision for the central bank to make loans, as I've mentioned earlier, to the DIC and explains what the permitted purposes of the loan must be in which the DIC is allowed to apply the proceeds of any loan. And also use of the emergency funding facility should be repaid from asset recoveries or levies on members. So that is also introduced in the amendments to the PDA. Lastly, the reforms also focus on strengthening the role of the DIC and are also designed to increase the speed, efficiency, and effectiveness of the DIC during the payout process. Proposed amendments will clarify that the decision to intervene and close an institution rests solely with the central bank as resolution authority. The amendments will also remove current provisions that require depositors to file claims with the DIC for payouts, slowing down the claims payout process, and also provisions which empowers the minister to reverse a decision that an institution is no longer viable. So those provisions will be amended and will facilitate a smoother, more efficient, and faster payout process for member institutions. The reforms will also introduce, as my colleague mentioned earlier, the Protection of Depositor AMP regulations, thereby creating a tiered system of violations by member institutions of the Deposit Insurance Fund, both banks and credit unions, that attracts penalties based on the severity of the breach and also for late and erroneous filings. These changes will make the deposit insurance scheme more operationally streamlined and ensure that compliance expectations of member institutions are clear. So just in conclusion, to wrap up, the aim of the reforms, and there are a number of reforms that we are introducing for both the resolution framework as well as the money transmission businesses and payment institutions. But specifically with respect to the resolution framework, the aim here is to strengthen financial sector resilience while ensuring that our frameworks remain aligned with standards that are internationally accepted. The reforms will create a more flexible deposit protection scheme that is responsive to crisis, enabling the DIC to use funds proactively in resolution, supported by emergency backup funding from the central bank. Meeting these objectives ensures that the central bank is able to continue to meet its key objectives as the resolution authority. And those objectives include maintaining financial stability and public confidence in the stability of the banking system, protecting depositors by ensuring prompt payouts of deposits, and minimizing costs to the public during times of distress. So again, if you have any questions or feedback, we welcome them. I think we're going to go into a question and answer period at this time, but also feel free to submit any questions, comments with respect to the legislation that we've presented this morning and the ones that we will touch on later on this afternoon to the policy unit of the central bank. And the email address is there. You may also call. And so please, as we go into the question and answer period, we just ask that if you have a question or comment, that you come up to the microphone. And I think there are also questions that we will be taking online as well. So thank you for your attention, and I will turn it over to Latoya.
Good morning. Any questions from the audience? In person? No? Okay. So we have one question online, and it relates to the administrative penalty legislation. Is there a rationale for applying an AMP for a self-reported error? If the goal is for the best data quality, wouldn't waiving fees for self-reporting errors be recommended? I would think that it would be in the best interest of the industry as a whole to not charge a penalty for self-reporting.
I believe the central bank is not acting unlike other supervisory authorities in this vein. We do not wish to support or erroneous reporting or allow for that to continue. Obviously, we want to motivate persons to self-report, and that's the reason for the less penalty if you self-report. But clearly, it's not the expectation or intention of the central bank to support erroneous reporting. And hopefully that addresses the question.
I could add to that. The imposition of penalties and sanctions is never just an automated process. So the central bank still exercises discretion in terms of around the circumstances that led to the error. And to the extent that, at the end of that process, you're determining that some sanction is necessary, then the consideration as to whether or who discovered the error, get some consideration. So that's important to point out, because there's no comfort at the end of the day if we're having to identify errors in reporting, regardless of who found the errors, given the use that is made of the information, and often when the errors are reported. So all of those are factors that are taken into account when we look at what has to be done.